Hello, Inderes TV viewers and listeners. Here I have Sampo's CFO, Knut Arne. We are going to talk about Sampo's third quarter results and, of course, some hot topics like inflation and insurance business. Knut, you're a new face on Inderes TV, but you've actually had a long career in different operations in Sampo Group. So could you tell a bit about your background?
Sure. How should I put it? I slipped into the insurance industry on a banana skin 25 years ago. And I never found a reason to leave, actually. So here I am. I've spent most of my career within the Sampo Group, like you say, about 2 decades in different positions. The last decade or so, I've been a CFO, first in If for 8 years, and then in the Sampo Group as the Group CFO now since 2019. I guess I'm some kind of Nordic citizen. I started my career in Norway, where I grew up, but lived most of my adult life in Sweden, and have by now worked quite a few years, both recently and also in the past in Finland. So that's very briefly me.
Sampo had, again, excellent results today. What are your general feelings about the third quarter?
General feeling is it's really, really good. We had, as you said, an excellent set of results across the board. All our insurance businesses performed well in the third quarter. Obviously, the result was very much driven by the excellent underwriting performance we have in our non-life insurance operations, where Sampo's underwriting profit grew by 40% in the third quarter compared to same period last year. And if we adjust for the fact that we have more P&C business in the group now than last year, and a bit of volatile COVID items, we have grown the underwriting profitability by 20% year to date, which is significantly above the mid-single digit target we set for ourselves at the CMD. On top of that, also Mandatum, our life insurance business, life and asset management, performed very well, with good growth in assets under management, leading to higher fee income, and also, of course, a very good investment result. Year to date, leading to a strong balance sheet and record high solvency ratio. So all in all, very pleased and a really good set of results that came out this morning from us.
Sampo has been selling Nordea shares at a rapid pace. So why Sampo is leaving Nordea in such a haste?
I don't think we're leaving Nordea in a haste. We're doing this in a well-structured way. We first made the decision to focus on our insurance operations with our large P&C business and Mandatum. Then obviously we have sold at 4 different occasions Nordea shares, taking carefully into consideration market conditions, financial market conditions, and obviously also the Nordea share price development. So this is a well thought through, structured process, and not any hasty decisions from our side.
I think many Finnish investors who love dividends were expecting more extra dividends when you return capital to shareholders, but you're also utilizing a lot of buybacks. So could you elaborate the reasoning behind the buybacks?
I think you started to point to the right group to listen to when you do capital returns, and that is shareholders. And Finnish shareholders is important, particularly on the retail side with many retail investors. We also have other shareholders in other jurisdictions that prefers buyback. So some shareholders prefer divvy, and some shareholders prefer buyback, and consequently we have a balanced approach to our capital returns, where we have initiated an ongoing buyback program. And when we sold Nordea shares a week or so ago, we also indicated management intention to propose to the board an extra divvy of at least €2. So it's a balanced approach with both buybacks and dividend or extra dividend.
Let's continue with the capital allocation. Sampo has set financial targets or your agenda till the year 2023, I think. Should we assume that Sampo is not keeping any extra capital in its balance sheet when you reach the end of your strategy period?
Like I said, we set introduced a capital management framework which set a target solvency range for the group of between 170 and 190% when we had our CMD in February. That is obviously a capital management framework and a target that we are committed to. So that is the range we are working towards. And I think we have good pace in coming to that range by doing the actions I already have alluded to, initiating the buyback from management, proposed extra dividend, and also an expansion of the buyback program and authorization to do so at the next AGM. And with the pace we've had so far, I'm not worried in terms of us coming to the 170 to 190 range within a reasonable period of time. But obviously, doing, for example, a buyback take a little bit of time, just sheerly, basically because of things like volumes in the Sampo share price and trading on different exchanges.
I actually had a follow-up question on that. It seems that the market is at least expecting that Sampo is selling the rest of the Nordea stake before the next spring's annual general meeting. So is there any reason to keep the extra capital in your balance sheet for a longer period of time, or should we expect you distribute everything even during this year? Next year?
No, first of all, there's no sort of deadline for us to sell additional Nordea shares or the 6.1% we own before next spring's AGM. We have financial incentives to now sell more Nordea shares and exit that holding within 12 months period of time. When we dropped below 10%, we have basically 12 months to exit Nordea before the tax position of that asset is changing and we have to pay capital gains tax. So that's the timetable that we are working towards. And in terms of returning capital, like I already have said, we already have taken actions based on the excess capital that we have created and will continue to do so, indicated by the at least €2 extra dividend and expansion of the buyback program. But also this is a structured approach, right? We sell some Nordea shares, we deploy that capital, we sell more Nordea shares, and then we take additional actions. So one step at a time, also when it comes to the 6.1% and returning capital.
You had nice progress with Hastings in the UK, and obviously insurance companies, as they get bigger, they get economies of scale and so on. So how do you view the Hastings long-term growth potential in the UK?
Hastings have, first of all, economies of scale. It's a large operator in the UK motor market. So it's not a question about lack of scale. Hastings is a company with state-of-the-art IT platform. It has very skillful people. It uses these abilities to do smart and agile pricing. It services its customers in ways that the customers want to be serviced, which again creates retention and customer satisfaction. And it's also well positioned to take advantage of some of the regulatory changes that are ongoing in the UK P&C insurance market. And all of this makes me conclude that we are well positioned to create growth in Hastings going forward and continue the growth trajectory which Hastings have been on for many years already. And on top of that, of course, it is important to focus on profitability when you grow, and Hastings very much do so. And the few quarters we've had so far reporting Hastings as a segment in Sampo shows excellent profitability of the Hastings business. So all in all, it's been a really good start of our new UK business segment.
Is unorganic growth still on the table?
Unorganic growth is always on the table for all businesses. What we've said as a group is that we have an M&A appetite for bolt-on acquisitions. When it comes to Hastings, just the sheer size of Hastings, such acquisitions would be, if they arise, would most likely be quite small in a Sampo scale. Just because it needs to have a natural fit with Hastings and be manageable in terms of taking advantages and create benefits out of such type of growth. But beside that, it's also a position it's also a business that is well positioned to grow organically. Non-organic growth is not required to develop the business further.
As I hinted in the beginning of the interview, inflation is now a very hot topic among investors, and of course higher inflation, if it continues, could also lead to higher interest rates. So how would higher interest rates affect Sampo and its portfolio?
Yeah. Well, first of all, on the asset side, if we sort of look at the different sides of our balance sheet, on our asset side, we have a very short duration, which of course means that we are very well positioned for taking advantage of higher interest rate and being able to reposition our portfolio and redeploy our assets. Then on the liability side, higher interest rate would create capital, because you basically, in a solvency framework, you discount your liabilities with higher rates. So both from these two perspectives, as a group, we are very much well positioned to take advantage of higher rates.
How would that affect competition? I mean that now when the interest rate has been low, the most of your results come from the very low or very excellent combined ratio. But if interest rate would rise, would that also hit more competition and make your combined ratio maybe a bit worse?
Yeah, sort of the rate market, it's not a real-time correlation to pricing. So if you have rate volatility or you have rates that are up a bit one day and down the other, there's no changes in insurance companies' pricing strategies. If you have a longer period of time where sort of consistently higher rates, of course, those rate levels you would eventually also use in terms of assumptions when you set insurance pricing. But that's not changing overnight. It's not like we watch at one of your screens or at Bloomberg or Reuters, whatever channel, what happened in the rate market last night and run and change prices. That's not how it works.
Thanks for having me, and thanks for the interview.
Very nice to meet you. Thank you.